These 8 states are quietly skimming as much as $3,000 a year from retirees, and most older Americans have no idea their state is one of them. The list shrank in 2026 when West Virginia officially stopped taxing Social Security benefits as of January 1st. That change leaves 8 states that still trim your benefit checks before they ever show up in your bank account. But here is the nuance almost nobody talks about. Even in states that recently eliminated this tax, some retirees are actually handing over more in taxes this year than they did before. Not less, more. That outcome occurs because a little-known provision in federal tax law operates in tandem with each state's own rules. When those rules overlap in the wrong state, they can quietly strip between $1,000 and $3,000 a year from a retiree's budget without ever showing up as a separate line item. Most retirees never realize what is happening because the state does not label the charge as a Social Security tax. Instead, it is buried inside the regular income tax return as a taxable share of your benefits. You usually notice it only after you run the numbers yourself. By that point, the decision that pushed your income over the limit is already locked in and cannot be undone. By the time you finish this video, you will know exactly which 8 states still tax benefits in 2026, how each state decides whether your payments are taxable, the 2 federal income thresholds that stack on top of state rules, the new deduction Congress quietly rolled out in 2025 to partially offset taxes for people age 65 and older, and the 5 planning strategies that can shrink or even erase this tax exposure before the current tax year closes. I'm Mark, and after spending more than a decade inside the financial industry, I've watched retirees repeatedly collide with rules no one ever explained clearly. Today's rule is especially dangerous because it hides in plain sight. Many retirees living in these 8 states do not discover that their benefits are taxed until the first year they suddenly owe money. So the starting point is simply knowing whether your state shows up on the list. There are actually 2 completely different methods states use to tap into Social Security payments. The first group is relatively simple. 4 of the 8 states charge a flat rate on whatever slice of Social Security is already taxable at the federal level, regardless of whether your total income is modest or high. Those 4 states are Colorado, Utah, Montana, and Minnesota. If you reside in one of these states and any part of your Social Security shows up as taxable on your federal return, your state automatically takes its cut too. Colorado often surprises people the most because it promotes itself heavily as a retiree-friendly state. Colorado levies a flat 4.4% income tax. Retirees age 65 and older may subtract the entire portion of Social Security that is taxable under federal rules. That sounds simple, but there is a critical catch. Retirees between ages 55 and 64 may subtract only up to $75,000 of retirement income if filing single or $95,000 if filing jointly. As a result, anyone who starts Social Security before age 65, which is common when someone claims at 62 to cover an income shortfall, pays the full 4.4% tax on the taxable share of benefits until turning 65. For a married couple collecting $30,000 in annual benefits with 85% treated as taxable federally, the Colorado hit before age 65 is more than $1,000 per year, and most households only notice after they file their taxes. Picture a Colorado couple in their early 60s. One spouse leaves work at 62 and claims Social Security early, while the other keeps a part-time job to maintain health coverage until Medicare kicks in. Their combined income ends up slightly above the $75,000 deduction cap because the working spouse's wages alone exceed that figure. Colorado then applies the full 4.4% rate to the taxable segment of their Social Security. During the 3-year stretch between early claiming and age 65, that couple pays more than $3,000 in state tax on benefits that would have been fully sheltered if they had structured the timing differently. That money is gone forever. They do not receive any reimbursement once they hit 65. It is simply the price of taking Social Security before qualifying for the full deduction. Utah is next. Utah has a flat 4.5% income tax. The state offers a specific Social Security credit, but the credit fades out as income increases. A complete exemption is available only if adjusted gross income stays under $54,000 for a single filer or $90,000 for married couples who file jointly. So, a Utah retiree whose income from pensions, part-time work, and required minimum distributions pushes total earnings over that limit loses the entire credit. For a couple just above the $90,000 threshold, the end result can be roughly $1,400 per year in state tax on benefits already taxed at the federal level, potentially up to the 85% cap. Montana taxes Social Security under rules that resemble the federal approach, which seems straightforward until you realize the state uses income thresholds that have not changed in decades. The basic threshold is $32,000 for married couples filing jointly, or $25,000 for single filers. Those numbers were set long ago and were never indexed for inflation. The practical effect is that nearly any Montana retiree with even modest additional income has up to half of their Social Security pulled into the state tax calculation. Montana's top rate on that portion can reach 5.65%. For a couple receiving $28,000 in benefits with 50% of that amount treated as taxable, the Montana bill approaches $800 a year. That may not sound massive on its own, but it piles on top of other taxes retirees already face. Minnesota is the fourth flat-rate state and also the trickiest. Minnesota offers a subtraction that fully shields Social Security for couples with adjusted gross income under $18,320 or single filers under $84,490. Below those thresholds, no state tax applies. Once income rises above those amounts, the subtraction phases out quickly, and the state tax climbs sharply. Roughly 29% of Minnesota Social Security recipients still pay state tax on their benefits, which means nearly 1 in 3 retirees. For those stuck in the phase-out band, the average annual cost runs between $200 and $2,200. So, if you live in Colorado, Utah, Montana, or Minnesota and your income is higher than the exemption levels I just mentioned, your state is taking a share of your Social Security every year. Most retirees never see a separate notice because the charge is simply folded into the normal state income tax return. The remaining 4 states work in a completely different way. This second group creates timing traps rather than flat, predictable rates. Connecticut, New Mexico, Rhode Island, and Vermont rely on adjusted gross income thresholds instead of automatic percentages. If your income remains under a specific cutoff, Social Security stays fully exempt. But if income moves even a single dollar over that line, the taxable portion of your benefits kicks in and the state starts collecting. The danger is that retirees usually cross these limits not because of day-to-day income, but because of one relatively large financial move, such as a Roth conversion, an unusually big required minimum distribution, or selling a rental property or second home. One sizable taxable event in a single calendar year can push total income above the threshold and trigger state tax on benefits that were fully exempt the year before. Connecticut begins taxing Social Security once federal adjusted gross income is above $75,000 for single filers or $100,000 for married couples filing jointly. Over that level, Connecticut includes up to 25% of Social Security benefits in taxable income at the state rate. The cap applies to the percentage, not the benefit dollar amount itself. That means a couple with $120,000 in adjusted gross income and $36,000 in Social Security may have $9,000 added to their Connecticut taxable income, leading to a state tax bill close to $600. Picture a Connecticut retiree at age 70 who has avoided state tax on Social Security for 6 straight years because her income sat just under $90,000. One year, she converts $60,000 from a traditional IRA to a Roth after following a friend's suggestion instead of consulting a tax expert. That move instantly raises her adjusted gross income by $60,000 for that 1 year and pushes her past the $100,000 threshold. Connecticut then taxes 25% of her Social Security benefits, adding nearly $500 of state tax. On top of that, the conversion drives her federal combined income well beyond the 85% federal taxation level, costing her several $1,000s more in federal tax. If she had split the conversion into 3 smaller amounts over 3 years, each staying below the state limit, the tax consequence would have been minor. A single appointment with a certified public accountant before making the move would have changed the outcome entirely. But once the return was filed, that tax year was closed and the conversion could not be undone. New Mexico sets its thresholds higher, so keeping the exemption is somewhat easier. Single filers who earn less than $100,000 or married couples under $150,000 may deduct Social Security in full. But once income crosses those lines, the deduction disappears altogether. Unlike several other states, New Mexico generally does not fade the deduction out gradually. This creates what planners call a tax cliff. Being only $1 above the limit can generate hundreds of dollars in additional state tax because the deduction shuts off immediately instead of tapering down. For retirees hovering near the cutoff, one Roth conversion done without looking at total projected income can generate a tax bill on benefits that were sheltered in both the prior year and the following year. Rhode Island uses a unique test. The state exempts Social Security only for people who have already reached full retirement age, currently 67 for most people approaching retirement, and whose adjusted gross income remains under $117,000 for most filing categories or $133,750 for married couples filing jointly. As a result, retirees who start Social Security early at 62 so they can access cash sooner end up paying Rhode Island tax on the entire federally taxable share for the 5 years before full retirement age, regardless of how high or low their overall income is. This trap depends more on age than on income, and many early claimers never realize it exists. Vermont is the last state in this second group. Vermont provides a full exemption for married couples filing jointly with adjusted gross income of $70,000 or less, or single filers at $55,000 or less. Between those numbers and the higher phase-out thresholds, only a partial exemption is available. Once income clears the upper cutoffs, the entire federally taxable portion of Social Security is hit with Vermont's regular income tax rates, which range from 3.75% to 8.75%. Depending on total income. A Vermont retiree who earns some extra consulting income or takes a one-time IRA withdrawal can see Social Security tax jump from $0 to nearly $1,500 in a single year. So the second group, Connecticut, New Mexico, Rhode Island, and Vermont, creates timing dangers that do not exist in the first group. A retiree can stay comfortably under the threshold for years and then suddenly trigger taxation because of a single financial choice that has nothing to do with Social Security itself. Here is the part that catches almost everyone off guard. Even if you live in one of the 42 states that do not tax Social Security at all, the federal government may still tax up to 85% of your benefits. This rule is found in Internal Revenue Code Section 86 and has been in place since 1983. The real issue is that the income thresholds that trigger federal taxation have not been indexed for inflation in more than 40 years. The first federal trigger point is $25,000 of combined income for single filers or $32,000 for married couples filing jointly. Combined income is defined as adjusted gross income plus tax-exempt interest, plus half of your Social Security benefits. Above that initial level, up to 50% of your benefits may be taxed federally. Above the second set of thresholds, $34,000 for single filers or $44,000 for couples, up to 85% of your benefits may be taxable. Because those numbers were set decades ago when every dollar went much further, almost any retiree with additional income now ends up in the 85% bracket. The real sting appears when federal and state taxes stack on top of each other. A Vermont couple receiving $36,000 in Social Security with combined income around $80,000 might see $30,600 of those benefits taxed federally plus additional state tax. Federal tax alone at a 22% bracket exceeds $6,700, and Vermont may add another $1,000 to $1,500. Put together, the annual bite on Social Security benefits alone can top $8,000, with the majority of the damage coming from federal law instead of state rules. Many retirees never mentally separate these layers, so they never look at strategies that reduce the combined impact. Consider a Minnesota couple in their mid-70s living in a home that is fully paid off. They receive a small pension of $24,000 a year and together collect $34,000 in Social Security. Required minimum distributions from a traditional IRA add another $45,000 annually. Their adjusted gross income seems moderate, and they do not view themselves as high-income retirees. Under the federal Social Security formula, though, their combined income is well above the $44,000 second threshold, so 85% of their benefits are taxable. Their adjusted gross income currently sits just under Minnesota's subtraction threshold of $18,320, which means no state tax on Social Security this year. But if market gains cause next year's required minimum distribution to rise, nudging income a bit higher, they could cross the state limit and suddenly owe roughly $1,800 more in Minnesota tax. Neither they nor their preparer may immediately recognize that the increase is tied to Social Security taxation. Congress did quietly add one partial offset beginning in 2025 that many retirees have not heard about, called the Senior Deduction. It was created as part of the One Big Beautiful Bill Act. This provision lets taxpayers aged 65 or over claim an extra $6,000 deduction on top of the standard deduction for tax years 2025 through 2028. Married couples in which both spouses are over 65 receive a total of $12,000 in additional deduction. The full benefit is available for single filers with income of $75,000 or less and couples at $150,000 or less. Above those levels, the deduction phases out gradually. Middle-income retirees, especially those in the 85% federal taxation band, gain the most from this change. Estimates from the Treasury Department indicate that about 88% of Social Security recipients now owe no federal tax on their benefits because of this extra deduction. However, the remaining 12% generally consists of retirees with larger pensions, more substantial investment portfolios, or higher required minimum distributions. For that group, the deduction lessens only part of the tax load rather than wiping it out. It is also important to understand that the senior deduction exists only in federal law and does not alter state tax treatment in any of the 8 states we've covered. So the full picture looks like this. Federal rules tax up to 85% of Social Security using thresholds that date back to the Reagan administration. Certain states then add another layer of tax on top. The new senior deduction reduces part of the federal burden, but it does nothing to reduce the state layer. Retirees who do not run these numbers each year often pay between $1,000 and $3,000 more in tax than necessary. The encouraging news is that 5 specific strategies can reduce or eliminate this exposure. All of them are completely legal and commonly used by retirees who work closely with qualified tax professionals. The first strategy is what I call the threshold gap year. If you know you will have a naturally low income year, such as the window between retiring and starting Social Security, that year can be ideal for Roth conversions, realizing capital gains, or taking extra withdrawals. Your income stays below key thresholds, your tax bill remains low, and assets shift into accounts that will never again push up your Social Security taxation. A certified public accountant or enrolled agent can calculate precise amounts before December 31st. The second strategy is a domicile review. Moving to a state that does not tax Social Security requires establishing genuine residency, not just buying a vacation property. A tax attorney or state tax specialist should coordinate the paperwork. States like Arizona, Florida, Nevada, Pennsylvania, South Dakota, Tennessee, Texas, Washington, and Wyoming do not impose state income tax on retirement income. Establishing domicile involves factors such as where your driver's license is issued, your voter registration, where your primary doctor is located, your main mailing address, and how many days you physically live in the new state. Many states follow a 183-day guideline, meaning if you spend more than half the year in your old state, it may still treat you as a resident there. Without careful planning, retirees who split time between states can end up owing tax in both places in the same year. The third strategy centers on the timing of Roth conversions. Retirees residing in Connecticut, New Mexico, Rhode Island, or Vermont should avoid doing conversions in years when income hovers just under the state thresholds. Completing conversions in years that are clearly below or clearly above the limits can lower lifetime tax by avoiding repeated instances of barely crossing those lines. A certified financial planner or tax advisor should run multi-year projections before you proceed with any large conversion. The fourth strategy involves qualified charitable distributions. Retirees aged 70, 12, or older may send up to $18,000 directly from an IRA to an eligible charity in 2026. This payment does not count as taxable income, yet it still satisfies required minimum distribution rules. Because adjusted gross income stays lower, this can be a powerful tool for retirees already planning to give to charity and who are trying to remain below state Social Security tax thresholds. The mechanics must be handled correctly. The money needs to move directly from your IRA custodian to the charity, not through your personal account. The fifth strategy is careful timing of required minimum distributions. Under federal law, you must take your first RMD by April 1st of the year after you turn 73. Choosing to take the first distribution in the year you actually turn 73 instead of waiting until the following year can spread the income over 2 calendar years rather than stacking 2 distributions into one. That can keep combined income from suddenly jumping above state Social Security tax thresholds. A tax professional should compare projected income for both years before you decide which path to take. All 5 of these approaches are fully allowed under current tax rules and are regularly used by retirees who schedule yearly meetings with a certified public accountant, enrolled agent, or tax attorney. The common theme is that planning must happen before December 31st, because once the tax year ends, most options vanish. The 8 states still taxing Social Security in 2026 are Colorado, Utah, Montana, Minnesota, Connecticut, New Mexico, Rhode Island, and Vermont. West Virginia only recently dropped off this list. Federal rules continue taxing up to 85% of benefits using thresholds that have not moved in decades, while the new senior deduction trims only part of the federal tax and none of the state tax. Ignoring these rules in the wrong state or mistiming a Roth conversion or property sale can drain between $1,000 and $3,000 per year from your retirement income. Your first action step this week is to pull out your latest state tax return and find the line that shows the taxable portion of your Social Security benefits. If that figure is above 0 and you live in one of the 8 states we discussed, you are directly affected. Step 2 is to contact a certified public accountant or enrolled agent before year-end and ask for a projection that compares your combined income against both state and federal thresholds. Step 3 is to decide whether any of the 5 strategies fits your situation and to implement the appropriate steps before December 31st.